Good afternoon. We're going to continue with the chapter on professional ethics. Independence is a big deal. Very few businesses have their own national holiday. Every July we celebrate Auditors' Independence Day. Independence implies an impartiality. We're charged not only with worried about what management needs, but also those who are using the financial statements. We believe if we are independent, it's easier to act with integrity, to be objective, and to maintain professional skepticism. Table of contents of the Code of Professional Conduct, Rule 1.200, Independence. The AICPA has developed a framework to assess independence. The steps in the framework are identify threats to independence, determine what an acceptable level is. If the threat is not at an acceptable level, you have to apply safeguards to mitigate the threat. I notice some threats cannot be reduced to an acceptable level by applying safeguards. With one exception, everything we're going to talk about today are threats that cannot be reduced to an acceptable level. We're going to talk about things that safeguards cannot reduce to an acceptable level. Here are the threats to independence. You don't have to memorize them. I would think some of them make sense. Adverse interest, advocacy, where you become an advocate for the client. We already talked about the carve-out for tax. Familiarity, as you become more and more familiar with the client, it becomes easier and easier to take their position. Participation in management is not allowed. Self-interest, this is a big part. If I own stock in a client, then I'm going to have incentive not to issue an adverse opinion. So self-interest is prohibited. Self-review, if I do the work, I can't audit it. If I prepare the financial statements, I can't audit them. Undue influence, this was a big issue with Enron. Enron was the biggest client in Arthur Andersen's system. This put a lot of pressure on the partners in the Houston office. So Andersen had a very decentralized system where the decisions were made in the office where the client was. So all the responsibility for Enron fell on the partners of the Houston office. You can imagine how influential Enron was in that office. Deloitte, on the other hand, has a system, they call them clients of the chairman's office. And their clients of the chairman's office, their big clients, answer directly to the chairman's office of the firm. So it's not just Microsoft influence on the Seattle office of Deloitte, but Microsoft, those decisions are made at the chairman's office of Deloitte. Here again, the framework. And with one exception, everything we're going to talk about today represents a threat that cannot be reduced to an acceptable level by safeguards. How do you evaluate whether you're sufficiently independent? This is the definition of an acceptable level, the level at which a reasonably and informed third party who is aware of the information would be expected to conclude that the threat would not compromise the member's compliance with the rules. Wow, that's really cut and dried, isn't it? Again, it's very judgmental and subjective. That's the world you're going into. But how would this look in the eyes of a reasonably informed third party who had access to the relevant information? Would that third party conclude that you were independent and that you were able to comply with auditing standards? Here's the handout. Now, please notice I'm going to talk about three sections. Section A, Section B, and Section C. So you'll want to have this in front of you as I go through the remainder of the lecture, because I'm going to refer to A, B, and C as I go through this. We've got covered members and we've got groups or professional employees. What's the difference between a covered member and a professional employee? Part A applies to covered members. It does not apply to all professional employees. It does apply to covered members. Part B applies to all professional employees. Part C applies to professional employees. We've got different periods of engagement. Part A applies to the period of the engagement. Part B applies to the period of the engagement. Part C applies to the period of the engagement and the period covered by the financial statements. Now, for me, it's important. I have to consider this as a first-time new client. An ongoing client, there's going to be overlap between the period of the financial statements and the period of the engagement. But I'm going to pretend in my mind that this is a new client and we didn't start anything till January 1st of 2020. The financial statements, on the other hand, cover the years 2018 and 2019. So with a new client, it's possible that there's a difference between the period of the engagement and the period covered by the financial statements. Part A, covered members, period of the engagement. Okay, covered members during the period of the engagement may not have a direct financial interest in the client or a material indirect financial interest in the client. They can't be a trustee of a trust or executor of an estate that has a financial interest in the client. They cannot have loans to or from the client. They cannot have joint investments with the client or the client's management. Part B, professional employees during the period of the engagement. During the period of the engagement, no professional employee or group of professional employees can own more than 5% of a client. Covered members are the people closely associated with the client, with the audit engagement. Professional employees are every AICP or CPA type person in the firm. And not just CPAs, but if you're trying to become a CPA, I would consider you a professional employee. So covered member are the people affiliated directly with the engagement. Professional employees, so if we're talking about a San Luis Obispo client, professional employees would be anybody in the system, the Miami office, the Houston office. Part C, professional employees, the period covered by the financial statements and the period of the engagement. So Part C is the only part that applies to the period covered by the financial statements. For an ongoing client, these two periods are going to overlap. But for a new client, then the period of the financial statements may be different than the period of the engagement. And no professional employee can act as a director or any capacity equivalent to management during the period covered by the financial statements or the period of the professional engagement. All covered members are professional employees. Not all professional employees are covered members. So if you're on track to be a CPA, you're a professional employee. I would say if the client bills your services out you're a professional employee. Whether you're in tax, audit, or consulting, if the client is sending you out to perform services and billing you out, then I believe you're a professional employee. Here is how I try and identify it. The first group is any professional employee or group of professional employee that owns more than 5% of the equity in any client anywhere in the system will compromise independence. Then we've got covered members. Now, covered members have immediate family and close relatives. Their immediate family cannot have any financial interest in the client. Their close relative can have a financial interest as long as it is not material to the close relative. If the close relative's investment in the client is material, it will impair independence. If the close relative's investment is not material to the close relative, then it will not impair independence. If you're not a covered member, you will not impair independence unless we go back to the top, you or some group of professional employees own more than 5% of the equity in the client. We're going to have to sort out who members are. Member means member of the AICPA. Covered member, professional employee. So we need to sort out these different words here and make sure we understand them. Okay, the book is written in terms of the framework. I think it follows very closely. I find nothing inconsistent with the handout I gave you and the framework. What I do believe is the handout is much more concise and it covers 90+% of what you need to know. So we're talking now about A, and it cannot be reduced to an acceptable level. Covered members had a direct financial interest in the client during the period of the engagement. Covered members had a material indirect interest in the audit client during the period of the engagement. So this can't be mitigated by safeguards. It will impair independence. We're still in Part A. We're talking about mutual funds, and this is, well, the first part here is cut and dried. If a covered member owns shares in a mutual fund, then the covered member has a direct financial in the mutual fund, and it will impair independence if we are auditing the mutual fund. So that's cut and dried. What is more difficult to work with is what if a covered member owns stock in Intel and their firm audits Fidelity. Fidelity is a mutual fund, and Fidelity undoubtedly has some Intel stock in their mutual fund. So we don't audit the Fidelity mutual fund, we audit Intel. However, we own stock in Fidelity mutual fund, we invest in Fidelity's mutual fund, and the mutual fund has some Intel stock. Does that impair independence? That would be considered an indirect financial interest. If the mutual fund is a diversified mutual fund with lots and lots of different investments, then it most likely will not impair independence. There are formulas to figure out what percent of the mutual fund you own, what percent of Intel the mutual fund owns, and there's these complex formulas. But if it's a diversified mutual fund, it probably will not impair independence. It's considered an indirect financial interest because you don't make the buy-sell decision. You don't decide whether the mutual fund is going to buy or sell their stock in Intel. So this is considered an indirect financial interest. We're still in Part A, covered member. Covered member serves as a trustee of a trust or executor of an estate during the period of the engagement, and they have authority to make investment decisions. Now, a CPA that's acting as a trustee of a trust or executor of an estate almost always has investment authority. That's why they've been asked to be a trustee or executor. We're not going to worry about the 10% here. We're just going to assume that if a covered member is a trustee of a trust or executor of an estate, then it will impair independence. We're still in A. A covered member cannot have a loan to an audit client or a loan from an audit client during the period of the engagement. This will impair independence. There are some exceptions out there, but we're not going to bother to learn them all. So if I have a mortgage at Wells Fargo and subsequently we get the engagement to audit Wells Fargo, I do not have to refinance my house with a different bank. I can keep my loan. So there's some exceptions there, but basically the rule says a covered member cannot have a loan to an audit client or from an audit client. We're still talking about covered members. Covered members cannot hold a material, joint, closely held investment with an audit client during the period of the engagement. We move down to B, professional employees. No professional employee or their immediate family or any group of such persons can own 5% or more of an audit client. So whether the covered members, if it's a San Luis Obispo client, most, not all, but most of the covered members are going to be in San Luis Obispo. Professional employees are all over the country. So a partner in Phoenix or a group of managers in Fort Lauderdale can't own more than 5% of the stock in our San Luis Obispo audit client. It will impair independence. C, cannot be reduced to an acceptable level. Any professional employee serving as a director, an officer, an employee, any capacity similar to management of an audit client during either the period covered by the financial statements or the period of the engagement will impair independence. Thank you, and tomorrow we'll go through some independence examples.